Live with personal finance. Give me just a second. I'm going to start the Zoom meeting. Hey, the Zoom meeting looks like it's actually going. So I just need to admit some folks. So welcome. Hello, everyone. Everyone is now entered who's in the queue. Sorry about the late start. Apparently Zoom had an update that wasn't quite ready for me to run, so I had to update Zoom. Maybe you had to do the same. Can you guys hear me? Hi, Alina. Hi, everybody. Looks like I may be muted. Yeah, I'm muted, huh? Can you hear me now? Yeah, imagine that. I need a little technical coaching every now and again. Thank you for that. Thanks for giving me a sound check. I got a new pair of AirPods. These are the Pro version. And I tried to use these so I didn't have to wear the Mickey Mouse ears. But I couldn't get it to work, and then I had to update Zoom, and I was late and started sweating, and I got really anxious, and it's been one of those mornings. So thank you for your patience, and welcome to another Zoom meeting. So I'm going to give everybody a couple more minutes in case someone wants to join. It looks like everybody who wants to be in at this point is in. Destiny is joining. Okay, so today we're going to continue our conversation about investing. I'm going to spend a few minutes reviewing last week's 4 investment strategies, and I'm also going to introduce you to really the basic idea of tax-advantaged investing, which is a big part of the course. It's a big part of personal finance. The ability to invest in a tax-advantaged way is a really important strategy for your long-term success. So that's really what today's lesson is all about, tax-advantaged investing. So we're going to get started here in just a minute. I'm going to give one more minute for folks to join, and in the meantime, if you would go ahead and pop in your comment that you are here, that'd be great. And now you can hear me. And also, this is a good time if you have questions to go ahead and post those in the chat. I'm going to spend some time at the end of the lesson to answer any questions you have. And one of the things I want to mention as I'm still doing my introduction, for those of you who are making an outline for this lesson, this is still the introduction. It's hello, welcome, and introduction. You guys are doing a great job, by the way, with the timeline outline. And I think I've had some students tell me that while it is additional work, it is helpful because it gets you engaged. And I'll tell you this, for those of you who are here every week, you don't need me to tell you this, but for those of you who are watching on the live stream, or most likely you're watching after the recording has been posted, for you, I got to say that it's like a lot of students in this course were AWOL. AWOL is absent without leave. And so what I found is a lot of students just simply weren't watching the Zoom meeting, and thus they had tons of questions, and thus they got a little behind or overwhelmed with the assignments. And so, we spend a lot of time, at least I think I do, on this Zoom meeting trying to clarify. And like today, I'm going to review this week's assignment, and I'm going to review last week's assignment a little bit. But my point is, this outline gets you engaged in the Zoom meeting, even if you're not here. And so, turns out that seems like a pretty good idea, and I think I'll be continuing to do that. Never did that before, but with this online teaching thing, it's very different. And since I can't look you in the eyeball and tell that you're here paying attention, it's just one of the ways I have to kind of make sure that I'm doing my job to help you succeed in the world of personal finance. So thank you for your understanding. I really didn't want to give you extra work, and I'll do my best to try to make your work more efficient and more effective as we move forward. But we are getting very close to the end of the course, and you guys have been great. So if you're struggling with anything, reach out to me, leave a comment below. If you're watching this later, just leave a comment, shoot me an email, shoot me a text message. I've been posting my contact information in GroupMe. It's on the syllabus. You know how to reach me. It's your responsibility if you've got concerns about your grade to reach out and say, hey, I've got some concerns, and I'll put you on my list, and I'll make sure that you get a little bit extra attention. And what I mean by that is a little extra attention, including possibly some extra credit homework assignments coming up. So those of you who don't need the extra credit because you've done what I've asked you to do, you've done your assignments, you've done them early, you've gotten extra points, you're way ahead of the game. So I'm sorry to bother you with this announcement, but that's the announcement. So again, if you have any questions, concerns, reach out to me. If you got questions right now, I'll spend some time at the end of the lesson and I'll answer any questions you have. So today, tax-advantaged investing. It's one of my favorite topics. Investing in general is a very popular topic in this course, and it's one of my favorite topics. Investing is kind of fun. I like to drive a motorcycle around town in Houston, which is a little risky. I'm not afraid of risk. I like to ski on, not black slopes, but aggressive blue slopes. Anyway, that's my personality. I like things that I don't mind taking risk. I own my own business. I've always been kind of a risk taker. And so investing is something that always involves risk. And if you learn how to manage risk a little bit, and that's what last week's lesson was about, 4 investment strategies designed to help you maximize returns and minimize risk. So last week's lesson, I'll review that quickly, briefly today, but then we're going to jump right into tax-advantaged investing. And by the way, tax-advantaged investing is one of the 3 laws of personal finance. So we've got the law of spending and saving, which basically says spend less than you earn so that you can save more for what matters most. And when you do that, when you save more for what matters most, if you're smart, and you will be smart, you are smart, that's why you're taking this course, you want to learn how to become more effective in managing your personal finances. So as you save more for what matters most, you don't just save it and leave it in the bank, you save it and you invest it, and you learn how to invest it wisely. So that's the first law of personal finance, is spend less than you earn so that you can save more for what matters most. And you get to decide what matters most to you. Everyone I ever worked with in my life, every conversation I've ever had around money, I try to start by understanding what's really important to you. And it's time for you to start thinking about what matters most to you. So just a little advance notice, we're going to do an assignment next week called The Blueprint for Financial Success. And the basic idea is to start out your financial plan, not with all this technical stuff that we've been talking about, but to really start out with what matters most. What are your goals? What's your vision, your values, and your purpose in your life? And the older you get, the more that is important to you. So that's the first law of personal finance, is spend less than you earn so you can save more for what matters most. And the second law is the law of tax-advantaged investing. The IRS makes the law, but your job is to take advantage of it. And that's what we're going to learn today. And the third law of personal finance is the law of purpose and commitment. And that goes back to that blueprint and the foundation of the blueprint. And the foundation of your financial plan really is to understand why. Why are you even going to be saving and investing for your future? Why? Is it your family? Is it to be able to spend more time on the beach when you're my age? You've got to figure out the answer to the question why. What matters most to you? So the 3 laws of personal finance are built on the foundation of what matters most to you. But tax-advantaged investing is a really important part of this whole shamazel. So my birthday is coming up and you don't have to send me a card or cupcakes. But my birthday is April 15th, which is tax day. And so my first son was born on December 31st, which means, if you don't know what that means, if you're not an accounting major, what that means is I took my son home from the hospital the last day of the year. Actually, we didn't even take him home until the first day of the year, because he was born on December 31st, the last day of the year. But the point is, I got to deduct child deduction. At that time, I believe, was $1,250. It was a credit, which means on my tax returns, I got a credit of $1,250. That's real money in my pocket because I had a son on the last day of the year. I got that credit for the entire year. So having, if you have that deduction by the end of the year, you get it for the whole year. So that's kind of part of my story of being focused on this thing called tax advantaged investing. There's so many stories I could tell you about people who have really only applied this one principle and have been very, very successful because they did this one thing that I'm going to teach you today. They took advantage of tax advantaged investing. So here we go. I just let someone in. The last one I'm going to let in. Now I'm not going to pay attention to the key. We're going to jump into tax advantaged investing. And this is week 11, so I will review week 11 assignment. I wanted to also just kind of highlight or summarize the perfect investment. Today we're going to talk about tax advantaged investing. Last week I introduced you to the perfect investment, which hopefully you recall. The perfect investment really isn't an investment at all. It's just putting money into a certain type of account. It so happens to be a 401k or a company retirement plan. And the reason that it's the perfect investment is because you contribute and the company matches your contribution. That's like making 100% on your contribution. So for example, again, if you make $100,000 a year and your company matches 8%, you have to contribute 8%. So quickly, what's 8% of $100,000? What would you contribute to your 401k because you don't want to miss out on the perfect investment? I'm looking for an answer in the chat box. Yes, Chris, $8,000. Yes, Sydney, Nicholas, Charlotte, Haley. Thank you guys. Awesome. I love it when you're with me. It's so hard to know that you're with me without this silly little chat box. So thank you. Yeah, it's $8,000. 8% of $100,000 is $8,000. That's your commitment to your future, to your 401k. And then your company matches it with $8,000, which totals in your account how much? Yes, Chris, you're ahead of the game. Way to go. I think I might have to get... Yes, Nicholas, you guys are awesome. You remember, that is the perfect investment. And it goes hand in glove with today's topic of tax advantaged investing, because not only do you get that $8,000 match in that perfect investment, but in addition to that, you get an $8,000 tax deduction, which means you don't have to pay taxes on that $8,000 until you take the money out. In April 15th, my birthday, I'm going to turn 59 years old. I don't know how I can give you extra points for this because it would make a lot of extra work for me, but if you would mention somewhere, either in the chat or in the comments, do that in the comments to this video if you want to really make me smile and wish me happy birthday. Tell me what is special about this year's birthday. I was born 4/15/1962, which means on my birthday, I will turn age 59. Something special is going to happen to me this year in terms of tax advantaged investing. And so that's just a curiosity question. I might post that in the quiz, maybe not, but just if you're thinking you know what it is, part of your assignment this week is going to be to kind of deconstruct the rules, boundaries, and limitations related to some of these tax qualified accounts, like the 401k. So let's jump right in. That perfect investment is just a reminder that on day one, when you get that dream job and your company is offering a match, and you sit down with HR and you complete the paperwork, you absolutely want to sign up for the IRA or for the 401k. You want to know what the match is, because if you know what the match is, then you automatically know that you're absolutely committed to contributing at least as much as the match, okay? That's key. That's one thing I want every student who ever takes this course to walk away with. Now, the next thing we went over last week were 4 investment strategies designed to maximize your return and minimize your risk over time. So those strategies work very, very well in your 401k. So if you're fortunate enough to be making however much, I say 100,000 because it's super easy math, but just imagine at some point you're making $100,000, and let's just assume your company's matching 8%, which is a really good match. If that were true, you would have 16 grand going into your retirement account every year. And with these 4 investment strategies that I'm going to review right now, these 4 investment strategies that are designed to maximize your returns and minimize your risk, if you put those strategies to work in your 401k, in the perfect investment, with the extra benefit of the match, I'm telling you, it's going to be a game changer for your future, for your financial future. So these are very simple to apply, very easy to use if you have the knowledge to understand what they are and how you put them into work for you. So again, here they are, the 4 investment strategies that we covered last week. The first one is diversification. And you'll recall I told a story about an elevator and how a mutual fund, which used to be the best way to invest, and if you listen to Dave Ramsey, he would tell you that mutual funds are the best way for young people to invest. And I say, not so much. In Dave's time, the mutual fund was new, innovation, it was great, it was. But you think you pay extra to have a manager manage those companies in the mutual fund, and that's what those cables represent, are individual companies, and the manager's job is to find the weak ones and replace them with strong ones. And over time, if the mutual fund manager is making money for you, that's how they're doing it. But there's a better way today, a more efficient way. It's called an ETF, an exchange traded fund, and that's my favorite. And it doesn't involve a manager. But I still use the elevator because diversification is really, it's about not having all your eggs in one basket. It's having the wisdom to know that you don't want to invest in one company in your 401k. So for example, let's say you work for Shell, or let's say back in the day you worked for a company called Enron. Remember Enron? Anybody know the Enron story? What happened in Enron was people were investing in Enron because it kept going up, 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 and they didn't want to miss out. FOMO, fear of missing out. Everybody was afraid they were going to miss out. And as Enron was cratering, the leaders at Enron, those despicable leaders at Enron, were telling the employees of Enron, there's never been a better time to invest. We've had such a ridiculous pullback in our price, in our stock price, that now is the best opportunity ever to get in. We're on a path to where we were and greater things to come. They lied, and people put in more money into their 401k, and they were basically failing to employ this strategy that helps you maximize returns and minimize risk. Mainly, diversification helps you minimize risk. So that's number 1. That's the first investment strategy that you need to understand, diversification. Next is asset allocation, and I didn't realize I grabbed an image from a student's account. I'm not going to say that student's name, but if you have very good vision, you can see it. It's pretty blurry, so hopefully you can't. But it's basically a picture of your financial plan. And your assignment last week was to use what you learned about asset allocation and apply it in your actual financial plan so that you could see how it moved the needle. And so asset allocation, hopefully by now you got to experience firsthand by playing around in your financial plan, hopefully you understand and you got to see with your own eyes the impact of asset allocation on your portfolio returns. This investment strategy, asset allocation, is the single most important determinant of your portfolio's returns. Asset allocation is really important. It's different than diversification because diversification just means spreading it out over a lot of things. Asset allocation is strategically spreading your investment out over specific asset classes that will operate differently during different market dynamics. So some things may go up while other things go down, and that's why asset allocation is so important. So this is second, really probably the most important investment strategy, asset allocation. Again, all of these strategies are designed to help you maximize your returns and minimize your risk. That's what these 4 investment strategies are designed to do. And I selected these 4 strategies because they're simple, they're absolutely effective, they're easy to put to work, and they work. They work really well, especially over time. So the third investment strategy, I told you a story about Farmer Joe's cows. And we went through the scenario where he decided to invest $100 a month and he was going to buy cows, and the cows were at that time when he started $100 a head. And I hope you guys remember you guys are putting funny things in the well, you're putting things, some of them are funny, and questions, and I'll get to your questions, but I just got distracted with some comments in the chat box. But back to Farmer Joe. So remember the story about Farmer Joe. The whole point was dollar cost averaging is an investment strategy. To me, and I think a lot of people would agree, it's the most powerful investment strategy designed to maximize your returns and minimize your risk. Of all the strategies, dollar cost averaging is the most powerful for a younger person who's going to be investing over time. And hopefully you understand that, but I promise you, if you don't understand it, just trust me and do it. And 5 years down the road, 10 years down the road, as we see markets go up and markets go down, you're going to experience gains in your investment accounts that are going to be remarkable because you trusted me with this one strategy. So basically, Joe, he committed to $100 a month. He was going to buy cows. Cows started at $100 a month. The next month, they dropped to $50. He bought 2, and the story goes on and on. At the end of 7 months, he invested $700 because he was doing $100 a month. But because of the price of cows fluctuating so much, he was able to buy 19 cows. The cows got up to $100 a head again. They never went over $100 a head, actually. He decided cows were too volatile. He'd stick with chickens. So he sold the cows, sold 19 cows at $100 a pop, which means he made a profit of, I'm looking at the chat now, see if you guys got the answer. If you're with me still. Yes, Sydney, you're right. He sold 19 cows for $100 a head. That's $1,900, but he had invested for 7 months, which is $700. So his profit was $1,200, and cows never went over $100 a head. That is dollar cost averaging. It's the most powerful investment strategy, in my opinion, and a lot of people's opinion, the most powerful investment strategy designed specifically to help you maximize returns and minimize risk. And you saw that in the story and Joe the Farmer Joe. That story makes sense. If you just think about that in terms of all the other asset classes that you're going to be purchasing when you set up your systematic contribution to your 401k with different asset classes like large cap, small cap, mid cap, international, bonds. You set up those 5 different and you spread them out 20% each, or however you feel like you want to do it. Then you're buying cows higher and lower, and the price is going up and down, but over time you're making money. And so that's dollar cost averaging. And the final one is portfolio rebalancing. And so again, when the cows get to be really expensive and the I hear someone speaking to me. Cy? Okay, somebody, I might have to mute everybody here in a minute, but no problem. You okay? It sounded like you were sneezing. Oh, cool. Ask a question. I'm sorry, I didn't take a breath. No, that's incorrect. That was like 2 weeks ago, but I changed that. Yep. Yeah. So, yeah, let's ask questions about the class at the end of the lecture, okay? That's kind of takes away the rhythm, you know what I'm saying? Thanks. So I'm going to mute everybody now. If you got a question, post it in the chat box. So we went from dollar cost averaging. The next strategy is portfolio rebalancing. And if you just think about the fact that cows went let's say cows went to $500 a head. And if you were Farmer Joe and your portfolio involved chickens, pigs, cows, and turkeys, 25% each, and if cows had turned out to now be 50% of your portfolio, you'd want to sell some cows and buy some chickens that are down to, say they're way down. So hopefully that makes sense. You want to keep your portfolio in balance, and the way to do that is systematically rebalance your portfolio. It's an investment strategy. In your 401k, it's super easy to do that. Most 401k plans at work, they have a button that you push. You log into your 401k and there's a place that says I want to rebalance my portfolio, and you click that. Some plans, a lot of plans have automatic rebalancing, which means you set it and forget it. Like you can say I want to do it every 6 months, I want to do it once a year, I want to do it every quarter. That's cool too, but it's an important strategy to understand. So those are the 4 investment strategies. Again, diversification, asset allocation, dollar cost averaging, portfolio rebalancing. Diversification is basic. It's the most simple. It prevents you from putting all of your investments in all of your money in one investment. You don't want to do that. It's a way to manage risk. Think about Enron. Enron is a perfect example of someone who did not diversify. Number 2 is asset allocation. It's the most important determinant of your portfolio's returns, because you're strategically putting different asset classes into your investment so that they operate differently. Bonds go up when stocks go down, typically. International, you don't know when they're going to go up and when they're going to go down, so you need to have some international in your portfolio. So you have different asset classes. Get to know the basic asset classes like large cap, small cap, mid cap, international, bond. Just get to know those asset classes and understand how they work a little bit. And the next one is dollar cost averaging, which is dollar cost averaging was Farmer Joe. It's the most powerful strategy there is for a young person to maximize returns and minimize risk. And then putting it all back into balance in a regular, systematic way is a good idea. It's like dollar cost averaging, except it's based on a calendar event where you just go and rebalance your portfolio. But think about it. It's very much like dollar cost averaging, where you're selling things that are high and buying things that are low, and it's a great risk management strategy that helps you grow wealth over time. Okay, so those are the 4 investment strategies we covered last week. That's the end of the review of the 4 investment strategies. So now we're moving on to this week's lesson, which is tax-advantaged investing. And so what you see here are, I say 3 buckets. They're 3 buckets, but there's really 4 buckets. It should be 4 buckets. This bucket, this big blue bucket, which you see on the picture, represents really not a tax-advantaged bucket. So there are 3 tax-advantaged buckets we're going to talk about today. And then there's this big bucket, which it could be 10 times this big. It could be as big as this room. It could be as big as this building. It could be as big as this property that I'm on. Okay, so the point is everything you own your house, the money in your mattress, your motorcycle, your car, your Winnebago, everything you own fits into this bucket. But just because it has value, and just because it fits into this basic bucket that you own, doesn't give you any tax benefits. And so this is a plastic bucket, and what it's designed to do is represent the fact that you can put anything you want in it, but it doesn't have any special value. It doesn't give it any protection. It's just there. If you get sued, they can sue you for everything in this bucket. This is just the big blue bucket that represents everything you own. So that's why that bucket exists. The next bucket we're going to talk about is this is your company retirement plan. So the 401k, I forgot to show you the big non-tax qualified blue bucket. That's this one. Non-tax qualified. That's what it represents. So no tax benefits here. It's just a bucket that represents something that contains everything I own. If it's a deed to my house or my motorcycle or whatever, land. This bucket, it's metal. It's not as big as a blue bucket, and it's got some rules, boundaries, and limitations, but it has some big benefits too, because this is the bucket that would be the perfect investment, the 401k. And it doesn't necessarily, as you're going to learn this week as you read your homework, this brown bucket, this big metal bucket that represents a business retirement plan, it's your retirement plan at work. So when I say at work, where you work, it's an employer's retirement plan, and you may be employed by a charity, a government job, or a corporation. Corporations use 401ks. Let's say you're a teacher. There's a different paragraph in the tax code, and by the way, that's what 401k is. It's the heading of a paragraph in the IRS code that describes the rules, boundaries, and limitations for this type of account. That's what a 401k is. But a 406b is a different paragraph that's very similar to this bucket. In fact, this bucket would represent a 403b, but it's just a little different. It's for teachers. And then you have, I think, 457 if you're a government employee, and there are different paragraphs in the tax code that have a little bit different language, but basically they're all the same. You put money in this, and it's tax deductible, which means you don't pay tax on it. Just because you have a 401k does not mean that your company's going to match it. The company decides if they're going to match it or not, but the IRS makes the rules around this bucket. So this bucket gives you certain protections. It also has certain drawbacks. For example, when I put money into this bucket, I cannot take the money out until, does anybody know what age that happens? This is where you get a little bonus point, because I told you I have a birthday coming up and I'm going to be a certain age. I don't know if you're paying attention to that. Or yes, Nicholas, you're right. If Chris, yes, everybody's getting it right. It's 59. So you have to wait. Can you imagine when I was 20 years old, putting money away until I was the ripe old age of 59? I mean, that seemed like freaking forever. Sorry, forever. But now here I am about to have a birthday, and I'm going to be 59, which means I get to start taking money out of my big brown bucket. But that's a drawback. I know that's a drawback to you. You get a tax deduction, but this money is for retirement. It's for later in life, and you want to be careful about just understanding that that's the purpose of this bucket. It has huge benefits that you can't get anywhere else. For example, if you work for a company that gives you a match, you're not going to get that anywhere else. That's a huge benefit, and it comes with this bucket. So the brown bucket, the 401k bucket. Now we move on to the tax deductible IRA, because it's a different bucket. It's got a little bit different rules. It's very, very similar to this, but the tax deductible IRA, it's not quite as big as this one, although frankly it could be. could be just as big as this one. But typically, like if you're going to invest, if you're going to put money into your own IRA, a tax-deductible IRA, that's what this represents. And if you put money into this, you get a tax deduction, but you have to follow certain rules, boundaries, and limitations. But in this bucket, you know, it's just like this bucket, except this is an IRA, which means individual retirement. Anybody know what the A stands for? Looking at the chat again. It's a very odd word. It's not a super odd word, but it's not what you think. Like I always thought IRA stood for individual retirement account, but that's not actually true. It stands for something else, the A. Anybody know what the A stands for? Going once, going twice. I don't see any answers in the chat box. Going 3 times. No one knows. Nobody's even going to guess. I mean, come on, you get extra points for guessing. IRA stands for Individual Retirement Asset Advantage. Good guesses. Those are wrong. Who said arrangement? Charlotte, you are right. You Googled that, didn't you? Did you Google that? I gave you plenty of time to Google that. Everything in Google says account. It is funny. Yeah, Olivia, I'm sure that's true. I've been saying that since 1996 when I got my securities license. I just always thought that's what it was. But Dave Ramsey set me straight. And I think the technically correct word is individual retirement arrangement. Nonetheless, this bucket is very similar to this bucket, except this is an individual bucket and this is your employer bucket, basically. So when you work for the company, your money goes into this bucket. Make sense? And when you leave the company, you can roll over this money into this bucket. And that's what you generally want to do. Because generally, if you leave this company, there's a lot more rules and there's more flexibility here. You can manage this money yourself. You can invest in whatever you want to invest. Where this company retirement bucket, it's only going to have the options that your company puts into it, which are usually very limited, frankly. So they'll give you certain ways to get different asset classes, like large cap, small cap, mid cap, bonds, but they're going to be a very limited number of selections typically. So, and there's fees on this bucket because your company doesn't want to pay the fees. Guess who they make pay the fees typically? They pass those administrative costs on to employees, and they come right out of the account. You never see them. They're just part of the fees. So you typically want to, when you leave a company and move on to another company, which I promise you most of you will do multiple times throughout your career, when you do that, you want to roll the money over into an IRA. And it has similar rules. You can't take it out until you're 59 and a half. So you can keep contributing to this. Let's say you quit working for a company, you set up your own, you work for yourself as an independent contractor and you want to contribute to your retirement. You can still contribute. And in your lesson this week, you're going to have to do a little research to figure out how much can you contribute. Because you can contribute a lot more to this than you can this. That's why the bucket's smaller. And that's one of the rules, boundaries, and limitations is how much can you contribute? How old? What are the rules about contributing? So I'm going to let you do a little research, but what I want you to understand is this is, again, a tax-deferred bucket. You get a tax deduction for putting money in here, and let's say, for example, that when you rolled your money over from your company and you put it in here, you decided, let's say you had $50,000 in here. And let's say that with that $50,000, you decided you wanted to buy a stock. Let's just pick a stock. Let's pick, somewhere in here I've got Apple. Got some really good stocks here, but I'm not finding Apple on that list. Let's go to this list. So let's see, how's Apple doing today? Apple's doing pretty good today. So let's go to a 6-month chart. Apple's doing pretty good. Let's go to a 2-year, 5-year. Let's go to a max. So this is Apple. Let's say that you put 50 grand into Apple stock. Man, that chart looks ridiculous. But if you would have taken your IRA money and put it into Apple stock back in 2009, a buddy of mine and I, we were looking at Apple stock and we wanted to buy it, but it seemed way too expensive. It was $125 a share. So today, what's Apple trading at? $126 a share. So what would have happened if you would have put 50 grand into Apple stock in your IRA back in 2009? Would you have made any money? This stock, you put it all, let's say you did not diversify, you put $50,000 into Apple stock. How much would you have invested? How many shares would you have been able to buy in Apple stock for 50 grand? How do you do that, Olivia? It's really pretty easy. You can, I know some of my coworkers got a check in the mail and just cashed it. Yeah, so if you leave your company and they send you a check, that check should go in, you should send it to a custodian. So I use Schwab. I love Schwab. You can use TD Ameritrade, E-Trade, Robin. I think you could do Robinhood, but don't. But anyway, you just find yourself a custodian and you set up an account, an IRA account. It takes 2 minutes. I can send you a link to set one up in 2 minutes. And then you take that check and you send it directly to the custodian with your account number on it, and they will deposit it into your new account. They send you the check, you deposit it, you set up an account, and you deposit the check in there. That's called a rollover. As long as you do that within 60 days, you don't pay the tax. If your friends cash the check, that's bad. I mean, it's stupid is really what it is. It's downright dumb. Because what happens is, if they're young like you, Livia, and they take the money, they leave the company, and they don't want to leave the money in the 401k, so they get a check and they go and buy a car with it or whatever. Not only do they pay the tax, it's like if they had 50 grand in their account or 10 grand, it doesn't matter, and they took that check, it's like they just made that much more money, which means they're going to have to pay tax on however much money they made, and they're going to pay a 10% penalty. So 10 grand, they're going to pay a $1,000 penalty. That's just bad financial moves right there. Instead, they would want to roll it over into an IRA, and then they could invest it and they could make it grow. And that's the whole idea of investing and wealth building. So that's how you do that. Let's see. That'd be great. Yeah, that'd be great. That's the biggest worst thing you can do is take money out of a 401k, because I mean, when you put it into that 401k, you want to leave it there until you turn 59 and a half, and then you get to spend it. But remember, when I start spending money out of my IRAs, I mean, I have most of my money is in IRA money, and when I start spending it, I have to pay tax on it. So that's the whole thing I want you to get out of these buckets, okay? I'm getting ready to show you the Roth IRA bucket. Well, I should go through the Apple example. So let me just quickly say, let's pretend, I got off track, Olivia, that was a great question, but I got off track. Let's pretend you invest in Apple stock. And now, this is going to look kind of crazy, but Apple stock was trading at $125 a share. So does anybody know, if I invested $50,000, how many shares would I have? 50,000 if it's $125 a share. Anybody? Just quick. Is that right? 400? I didn't do the math. So 400 times 125 is 50,000. Are you sure about that, Sydney? 400 shares? 400. Okay, cool. That's good. I'm going to trust you on the math. So if I put 50 grand back in 2009 into my IRA and I bought Apple stock for $125 a share, I'd have 400 shares. So thank you. Alina confirmed your math. Olivia, Sydney, you guys are awesome. I'm really bad at math, but I'm really good at making money. And so I bought Apple stock in my IRA back in 2009 for $125. Today it's worth how much? How much is Apple stock trading at today, right now, as I showed you on the chart? It's trading at how much? Somebody put it in there. It's right on the screen. But it looks like Apple stock is trading at about how much? Thanks, Chris. Chris also confirmed. Now, Chris, can you tell me by looking at the screen how much Apple stock is trading for? Can you see that? Let me see if I can make it bigger so you guys can see it, because apparently you're not seeing it. So does anybody now know how much? It's blurry. Okay, thank you there. It's not blurry now. Yeah, that's what it's trading at right now. So how much would I have in my IRA today if I invested 50 grand in Apple stock in 2009 and it was worth 125 bucks a share at the time? So I got it for 125 bucks a share. Today it's worth 126. How much money did I make? This is a trick question. I hope if you're watching this on YouTube or Facebook and you're able to just do a little bit of research, like Google that and see what I have in my IRA today. So Olivia says 126, so like 9,000. So Olivia, I'm not sure where you get like 9,000, because if I only made $1 a share on 400 shares, I would have made, that would be $50,400, right? Basically, something like that. So it's more than 50 grand, Chris, because I made $1 a share according to what you guys are saying, but that's totally wrong. So does anybody know what a reverse split is? A stock split, you ever hear of that? I'll just tell you the short version. They reverse split shares. Nicholas, yeah, how many times, how many shares? Do you have any idea? Anybody? Because this is kind of important, and I think I know the answer, but I'm not positive. I know they did a 7-to-1 split at one point, and then I think they did it again, 2-to-1, or another 7 to split. So nobody knows. We should know that. I should know that. I'll find out. And next time I do this lesson and use this example. So I know they did 7-to-1, which means instead of 400 shares, how many shares would I have? If they did 7-to-1, how many shares would I have? 7-to-1, 7-to-1. Instead of, after the 7-to-1, they did a 4-1. Oh, thank you. Awesome. So instead of 7, it's going to be, wouldn't that be, let's just say 11. So 11. I bought it at 125. Well, let's just, if we did the math real quick, math is associative, so this should work. So let's just say 11. 11. I think, I don't know that this is going to work, but let's just use it. If I had 400 shares and they did an 11-to-1 reverse split, how many shares do I have? Let's just say 11 times 400 would be 11 times 400. I'm looking at, I'm terrible at math, so I need your help. 11 to 1 reverse split, and I had Alina, that's 44. I could do that math actually now that I think of it, because 11 is a really easy one to multiply. So 4,400 shares. I have 4,400 shares in my IRA. I started with 50 grand. I invested in Apple stock in 2009 for 125 bucks a share. Today it's trading for 126, but we do an 11 instead of 400 shares. How many shares do I actually have? Because they split it and they split it. 4,400. So somebody help me out now. How much is my IRA? How much do I have in my IRA that was 50 grand back in 2009, and my IRA account now has, instead of 400 shares of Apple stock, I have 4,400 shares, and today it's trading at how much? How much is it trading for today? It's trading for 126.78 at the moment. And so I'm waiting for some mathematicians out there to throw a little math at me in the chat box. Oh my goodness. So Nicholas says about $554,400. About. Not to the penny. That's a big number. I got around 557K, Olivia says, but I'm lost, so I'm not sure if it's right. Awesome. I love it when somebody tells me they're lost. So just think about it this way, Olivia. You buy a stock. Let's say you just buy one share of Apple stock in 2009. But you just hold it and you hold it and you hold it. You don't do anything with it. And the company, the price of that stock goes up so much that the company, Apple in this case, decides, you know, $1,000 a share, that's more than we want everybody to be able to buy our stock, so we're going to just make the price lower. We're just going to divide up your one share, so now it's 7 shares, okay? And so over time that goes to, you know, it went from 125 to 1,000, and then they split it, so now you have 7 shares, but instead of being worth 1,000, they're worth 1/7 of 1,000. So let's just say $130 a share. I'm not sure if that's right. Somebody could tell me, but yeah, 142. Thank you, Charlotte. So now you have 7 shares instead of 1, because they did a reverse split. Now you have 7 shares, and instead of it being worth, it went all the way up to 1,000. And now it's 142 a share. And so now you have 7 shares at 142, and now it goes to, let's say it goes to $300 a share, and Apple does, or let's say it goes to $500 a share, and now Apple does a 4-to-1 split again, a reverse split. So now instead of having 7 shares, they do a 4-to-1 reverse split, and now how many shares do you have? Instead of 7 at $500 a share, instead of having 7 shares, they do another reverse 4-to-1 reverse split. Instead of having 7 shares, you now have how many shares? 7 times 4. Instead of 7, they broke your shares into 4 parts. It gave you a whole share, but it's worth less. But instead of 7 shares, you have, somebody put it in the chat box. How many, am I losing you? Are you not getting this? Yeah, Lena, it's 28 shares. Olivia, you got that? Does that make sense so far? Just follow the splitting thing. So that's it. This Apple stock literally did that. They did a reverse split, and then they did another reverse split, all since 2009. Finally, today, the stock is worth $126 a share. But instead of you having 1 share, you've got 28 shares. So how much money would you have? Yeah, the reverse split is very confusing, but my point is just that, and all that is kind of confusing because Apple stock is confusing, but it's an amazing investment. If I would have actually done what I just said in 2009, wow, how smart would I have been? Because today I would have over $500,000 in my $50,000 IRA account, and I would have paid no tax. In fact, if I would sell Apple stock and go to completely cash, because think about this, I'm 59 and a half now, and I don't want to take a chance on this stock, this Apple stock, going down. Now, I wouldn't sell it today if I was selling it, but let's say that the stock is way up here at 100. It was the high of this stock. Apple went all the way up to 144. So if I would have sold it at 144, it would have been more like 600 grand. But here's the point. When you get to be old, like, I know, 59 and a half, at some point you're going to want to take risk off and just have a more steady income. You don't want to take a chance on it going down. So if I sell the Apple stock in my IRA account, that's a tremendous amount of profit. If I would have had that Apple stock in this account, this non-tax qualified account, and I sold it, I would have to pay tax on $500,000. $500,000 profit in that same scenario, as opposed to $500,000 profit in this account. Does that make sense? Olivia, did you get that? Why this little bucket is so much better than this bucket? Because it's tax advantaged. So that's, this bucket is an IRA. Now, let's transition now to the next bucket, which is, come on, get my iPad working for me, the tax-free bucket, which is the Roth IRA. And this is my favorite bucket. So let's just do the same basic scenario with the Apple stock. I had $50,000 in my Roth IRA 2009. I invested it all in Apple stock, and today I'm going to sell it at $557,000. Does anybody know? Can you tell me, anybody at this point who's watching, listening, and if you're watching on, if you're watching this as it's recorded, please leave a comment below to show me you're listening and that you get this, because this is like the magic moment in today's lesson. Does anybody know the difference? That same illustration of Apple stock, if I sell it in this account, or I sell it in this account, let's say the same thing, I've got all this extra profit in this Roth IRA. I invested 50 grand in Apple stock in 2009. Today I sell it with a $500,000 profit. And I'm turning 59 next week, and I'm going to start taking the money out. Now this is pretty awesome, right? The IRA, I sold the stock and I did not have to pay tax on the profit. Unlike this, if I sell the stock in this account, I pay the taxes this year. I got to pay the taxes because it's a non-tax qualified account. Unlike this one, I sell the stock, I don't even have a taxable event. However, when I turn 59 and a half and I start taking $100,000 a year, or say $200,000 a year, or whatever, say I take $100,000 out to live on, out of that 500 grand. Next year I go see the world. I enjoy my retirement because now I got money in my IRA that I can take out. What happens when I take 100 grand out of this to go have a worldwide tour travel party? What happens when I take 100 grand out of my IRA account after I'm 59 and a half, Rayon? Yep, I get taxed. I pay tax on the 100 grand that I take out. So just understand that you get a tax deduction, but when you take the money out, you got to pay taxes on what you take out. I didn't have to pay tax on the Apple stock that I sold. That was not a taxable event. That's awesome. That makes this bucket better than this bucket, way better. However, what makes this bucket better than this bucket is that same scenario, my Apple stock appreciated. I now have over $500,000, 557 grand in this Roth IRA. Now I'm 59 and a half. Now I want to go see the world and blow 100 grand on just travel and enjoying things because I can afford it. What happens when I take 100 grand out of this account? This is the moment you should all be like, wow. So you got it. It's tax-free. Nicholas, that's exactly right. I already paid the taxes on this. I don't get taxed. So I didn't get a deduction when I put the money in here, but I accumulated 50 grand in my Roth IRA, and then I invested it in Apple stock, and it had amazing growth, and so now I've got all this profit, and I take it out of this and I spend it, and I don't have to pay any taxes. And that's the benefit of the Roth IRA. Now, I told you most of my money is in this type of account because over my lifetime I've wanted and needed the tax deduction to reduce my income taxes this year, because I'm all about reducing my taxes this year. I still contribute to this, and you're going to have to do a little research to figure out what are the rules if I'm putting money into this and this at the same time. What are the rules? I can only put $7,000 a year into either this, or I can do both and I can split it. But the way typically most of us do it is we have a company account. Even though I own my own business, I set up a business retirement account and I fill it up every year. And then at some point I get to pour it into my IRA. And that's why I have so much of my wealth in an IRA bucket, which means when I spend it, I have to pay the taxes. So I'm not going to get in any big hurry to go spending money out of this bucket because I know I'm going to have to pay taxes. Unlike this bucket, if I need money out of this bucket, I can take it without paying taxes. This bucket is by far the most valuable bucket. It's the Roth IRA. It's the only tax-free investment there is, and that is essentially the lesson on tax-advantaged investing. And you may have noticed the shovel. I want to talk about the shovel for a minute because the shovel is, let's see, this is the number one bucket filling tool. So I want to just talk about this bucket. So all these tax advantage strategies require you to have earned income. So this bucket represents earned income to me. I may have told you this story before, but I want to tell you real quick since the bucket's in the picture. Since the shovel's in the picture. This is the bucket, the tool that you use and I use to earn income. When I think I was like 10 years old, there was this guy, Julius Irving. He was Dr. J. He was like, he could dunk from any direction. He was awesome. And I grew up in Lansing, Michigan, and I watched Magic Johnson become a superstar at Michigan State University, so I was into basketball. But anyway, when I was a kid, Julius Irving came out with these Converse tennis shoes that were leather. At that time, my family and pretty much everybody wore these canvas Converse tennis shoes, and they were fine. They were $4 for low tops at Kmart. That's how much they cost. I had 4 kids in the family at the time in our family, and my mom didn't work, and I wanted those leather tennis shoes. I went to my mom. I said, "Mom, I really want those tennis shoes." And she's like, "Talk to your dad." Talked to my dad. Said, "Dad, I want those leather tennis shoes." He's like, "Hey, if you want those leather tennis shoes, I can show you a way to get them." So my dad gave me a snow shovel. That's what this represents. And it was a Saturday when we had this conversation, and we just had a big snowstorm. Remember, I lived in Lansing, Michigan, and I'm talking like over a foot of snow. My dad looked out the window. He said, "You see all those people out there? Their driveways are full of snow. Take this shovel, knock on the door, and ask them if you can shovel their driveway." And, he said, I said, "Well, how am I, what?" He told me if I do that, they'll pay me. I'm like, "Really? How much will they pay me?" He said, "I don't know. You have to figure that out. You have to ask them, how much will you pay me?" And he said, "Or you can tell them you need, $10. That scared me. Like, I couldn't knock on your door and say, "Hey, can I shovel your driveway and I'll charge you $10. I would just say, "Can I shovel your driveway?" And I had nice neighbors, and they let me shovel their driveway. And I didn't even tell them how much it would cost. They paid me, most of them. They just gave me $20, $10, $15. And before long, that stupid shovel made me a ton of money. I came home that Saturday with a pocket full of green cash. And from there, my dad let me buy a lawnmower from him, cheap, very low price, but it was good and it worked, and he helped me keep it running. And I took that lawnmower and I did the same thing. Knocked on the door, "Looks like your grass needs to be cut. Can I cut your grass?" And I got some regular customers that paid me every week to cut their grass during the summer, and I always had money in my pocket. And I was like 10 years old. I was a big kid for 10 years old. So my story, my life, from very young has been kind of entrepreneurial. That may not seem like the definition of an entrepreneur to you, but I promise you that's exactly what it is. You pick up a shovel and you earn some money. All these strategies that I showed you today, the tax advantage investment strategy, require that you earn income. You can't contribute to a company plan if you don't have a job. You don't get to put money into an IRA or a Roth IRA if you don't have earned income. So you can't just inherit the money and then put it into a Roth IRA. It doesn't work that way. So that's why this becomes an important element in personal finance, is your developing your own value, your own skills, so that you can go out into the marketplace and add value. And I didn't want to leave that out of today's lesson because it's a very important part of the lesson. So that finishes us up pretty much. I'm going to quickly review the lesson, but you'll see it in Blackboard in just a few minutes. You're going to have to identify a few of the rules, boundaries, and limitations for a Roth IRA and a regular traditional deductible IRA, but it's all pretty much laid out there for you. The questions are, and then you're going to submit one PDF with about 500 words to explain in an article what you did. And you're going to have some work to do in your financial planning portal, and you'll see that I'm asking you to go ahead and give yourself $50,000 $150,000 actually, and then I want you to allocate it. I want you to allocate it in your plan in a company retirement plan, an IRA, and a Roth IRA. Well, you get to allocate it however you want, but I want it to be in a tax deductible account and a tax-free account and a non-tax qualified account, because I want you to see how that moves the needle in your plan. So you get to go play with that in your plan. It's called tax allocation. Very similar to asset allocation, which is what you did last week. But this week you're going to tweak your accounts a little bit. You're going to come up with some imaginary money that allows you to see how that impacts your plan, how that moves the needle on your plan. So hopefully that was helpful. That's tax advantaged investing, and that's going to do it for this lesson. Now I'm going to stick around for any questions you might have, which you can pop into the chat box now. I'm going to, well, I'll keep the live stream running while I look over these questions. And I'm looking for any new questions. If you don't have a question, you're welcome to depart, and I'll post the assignment very shortly. But right now I'm just looking at the chat. You guys have a great day, a great week. If you don't have a question, you're free to go. Yes. Good. How are you? You know what? Let's take a minute and look at your assignment. I'm going to go ahead and stop the live stream right quick, and then hang on, and we will